Volatility just spiked 40% year over a year in crypto and Forex markets, and most bots are getting liquidated because they weren't designed for this kind of chaos. But here's the thing. You don't need a completely new bot. You need 5 critical parameter adjustments that will keep your strategy profitable through the storm instead of blowing up your account. Welcome to FinTech Bot Focused, where we talk about automated trading, AI tools, and all the FinTech innovations that actually matter. If you're building bots, testing strategies, or just trying to understand how to automate your way to consistent returns, hit that subscribe button right now. Our volatility storm video hit 33% engagement last month, which tells us something important. People are scared right now, and they should be. The 2026 VIX is running 35% higher than the 2024 baseline. That's not a small move. That's a regime shift. And if your bot is still configured for 2024 calm markets, you're basically running with no seatbelt. Let's talk about the 5 settings that change everything. Setting number 1 is position size scaling, and this is probably the most important one. Here's how it works. Instead of keeping your position size fixed, you reduce exposure automatically based on a square root calculation of the volatility ratio. Think about it this way. If volatility doubles, you don't cut your position size in half. You cut it by the square root of 2, which is about 1.4. This keeps you in the game during spikes while protecting your equity. Historical backtesting shows this single change cuts liquidation risk by almost 35%. Setting number 2 is dynamic stop losses. Most bots run with a fixed stop. Bad idea right now. What you want instead is a stop loss that expands during spike periods and contracts when things calm down. So during normal market conditions, maybe your stop is 2% below entry. When volatility spikes above the 75th percentile for your time frame, that stop widens to 3.5 or 4%. This prevents you from getting shaken out on noise while still protecting capital on real moves. Setting number 3 is rebalancing frequency, and this one surprises people. Instead of rebalancing daily on a schedule, you shift to event-triggered rebalancing. Link your bot to a news calendar. When a major economic release is coming, your bot knows to reduce correlation and tighten up. This cuts the whipsaw factor dramatically because you're not forced to rebalance right into a headline move. Setting number 4 is correlation decay management. When markets get volatile, correlations break down. That hedge you thought was protecting you suddenly doesn't work. So what you do is reduce your hedge ratios automatically when correlation starts to decay mid-trade. Track rolling correlations over the last 20 bars or candles. If they drop below your baseline by 15%, cut hedge exposure by 25%. It sounds counterintuitive, but it keeps you from fighting a market that's repricing in real time. Setting number 5 is your slippage buffer. During normal volatility, limit orders work fine. But when we're in high volatility windows, your orders just don't fill. So you increase your limit order price tolerance by 0.5 to 1.5% during these spikes. You're paying a tiny bit more for certainty. And certainty is worth it when the volatility is running hot. Here's the result of implementing these 5 changes. Same underlying strategy, same signals, but 60% fewer liquidations and a 25% improvement in your overall stability score. These aren't theoretical numbers. This is what multiple backtests across different asset classes and time periods show us. Before you go, make sure you join the FinTech Bot-focused newsletter. You'll get updates on new bots and AI features, strategy breakdowns, my honest takes on what's working, and early looks at new automated trading tools. You can reply with video topics you want covered. The link is in the description. Join the community and stay ahead of the automation curve. One more thing. This video is for educational purposes only. It's not financial advice. Trading, especially automated trading, involves real risk. Always trade at your own risk and test everything before you go live. Thanks for watching, and I'll see you in the next one.